Chapter 2. Chapter 2. Now we're going to start recording business transactions. Last time, if you remember, we start putting all the transactions. We start analyzing the transactions. So what we did last time is we found the definition about accounting, and accounting is not just one activity, it's just all system of different activities. First activity is analyzing transactions, recording transactions. Then after recording the transaction, analyzing the information from the transactions, putting all the information into the reports and explaining those reports to the decision makers. Now, who are the decision makers and who are the users of the financial information? Define the two types of accounting that we have in the company. One accounting was financial reporting. So basically, in financial reporting, we report what's happened in the company to the people who wants to make a decision for either investing, either lending money. So why people want to invest or lend money is because they have money. Why the company wants to borrow or attract the investors? Because they don't have money. That's the thing that you have to understand. It's a very simple. The whole relationship and no creation of the companies, and no creation of everything, the business, it's very simple. If you have money, you're not going to look for money. I was working in the company, which is professional architects. These guys, they never borrow money, ever. They were in business more than 25 years, and they never borrow money from the bank. Why? Because the business itself generating enough cash, so they don't have to worry about the cash. They don't need investors. They don't need creditors. They don't need any of those. Why? Because the business itself is generating cash. So that's not the case with all of the companies. That's why we have two types of accounting. One is the financial reporting. Again, financial reporting, we're going to prepare those reports of the company and what's happening in the company for the period of time. For the people who wants to decide, should I invest in this company or should I borrow money? Again, those are the people who have money. Second type of accounting is managerial accounting. If you have a chance to take that course with me, that's course 2320, managerial accounting. In managerial accounting, we're going to see, we're going to use the same information from which we're using to financial reports. But we're not going to prepare financial reports for the entire company because we're not preparing the reports for the outsiders. We're preparing the reports for the people inside the company in order to make a management decisions. So now we have to go to the definition was the management decision, but that's going to happen in course 2320. And then you're going to see that the reports that we're preparing are for the internal users for making management decisions in order to keep a client or to keep the product or keep a product line or to continue the business, expand the business or close the business, what exactly they want. The next thing that we saw last time was that holder accounting. That means the system of identifying transactions, recording transactions, analyzing all the information, preparing reports, has to have some qualities. And we found the qualities are to be comparable, to be easy to understand, to be reliable, to be timely, to be useful. So once the information meets all those criteria, then it's useful for the decision makers. Those are the outsiders again for the company. We're preparing here this accounting. We only talk about outside people, which are the creators and investors. And last time we saw that we're doing some small transactions with the accounting involving the accounting equation, which accounting equation is assets, which is equal to liability plus equity. In other terms is whatever company have as assets, we're going to call it resources. Resources for which resources company can operate. Those resources are acquired either from investors, which is the equity or the owners of the company, or either through lenders by borrowing company from the creditors. Those are the only two options we have in order to acquire resources in order to operate. So now we can make the transition now to chapter 2 and see what we have to record. So first, again, we're starting with simple thing is this company start operation. When the company start operation, there will be events. Now, what we have to do once we see the event, first we have to identify and analyze, is this event actually related to the company? And if it's related to the company, is this a transaction? If you identify, yes, this is a transaction, in fact, then we have to record that transaction in the journal. Journal will be, imagine this, what I said to the other group the other day, is imagine you have this drawer, big, ginormous drawer. In that drawer, you have a different shelves or different boxes. Now, every boxes will be a count. When you open the box, there will be a sheet. On that sheet, always going to have, by the chronological order, we're going to start recording. On that date, we purchased this. On that day, we use that much. So what we're chasing is in the box, what went in and what went out. So now when we combine all the boxes, we're going to put it, all the sheets, they belong to each account, all the sheets together, we sitting in that big drawer. That drawer will be our ledger. In front of the drawer, for simplicity, we're going to keep a list with all the boxes, box 1, box 2, box 3, box 4, and there will be what's the content of each box. Every time when the content change, either something going in, something going out, we're going to change the number on the front of the box. Imagine this, we have this, now they're selling this fancy fridges, which out front you have this active screen, which is connected to the internet and the stores and everything. So that every time when you want to see what you have in the fridge, you look at that sheet, which sheet in this case, we're going to call it trial balance. And you're going to see, I have that much milk, that thing, that thing, that thing, that thing. Now, if you choose a recipe, the fridge is going to tell you, you have all the necessary ingredients to actually uh, make this food, which is on the recipe, or the fridge is going to tell you you're short on this food, on this particular ingredient. Do you want me to order it for you? And if you want it by yourself, how much you want to order? And then that when you open the fridge, you're going to see the ledger with all the ingredients. So now why we have 4 liters milk, we have to see the sheet for the milk, and we're going to say we have a 4 liters milk because at the beginning of the year we didn't have anything. After that we purchased 5 liters, then we're using 4 liters, then we purchased that many, we purchased that many, that many, that many, that many, and currently we have that much. That's why we have that much. That's going to stay on the journal. So that's what we're going to do in the chapter today. That's what we're dealing. We're dealing with identifying the transaction, put it in the journal, recording all the journal is put it in the same ledger, and preparing the balance, trial balance. Next time, we're going to see how we journalize the post-journal entries, what's happened after we preparing this unadjusted trial balance. Now we have to make some adjustments, and we're going to prepare this adjusted trial balance. After that, we have to prepare the financial statements, close some of the accounts, and we're going to prepare another trial balance, which will be the after the closing balance. So that's how it's going to go with those chapter 2, 3, and 4. Today, we're going to deal with the transactions, recording transaction journal, post the journal into the ledger account, and prepare an unadjusted trial balance. So let's go with organization. In order to do that, we have to have some system in place, which will be the accounting system. What will be the accounting system? Again, we're going to have a accounts. Again, imagine the drawer, and we're going to have different boxes for everything. Each box is going to be account. What we're going to keep in that account? Information. First, what went in, what went out, how much we have in the box. That will be everything that each box is going to have this journal, which journal is going to tell us what's happened in each box by in chronological order. We have to keep it in chronological order by dates. All the boxes in that drawer will be our ledger, which will be either put now in accounting. We're not going to put it this way. We're going to put it in the binder. In the binder, we're going to have every binder will going to be our ledger. Every single page, it's going to be our account. And in every single page, we're going to keep track of coming in, going out, coming in, going out. That will be our journal. At the front of at the very front of the binder, or on the on the front of the drawer, if we go with the drawer, we're going to have a list of all the boxes and the content in the boxes at current time. That will be our trial balance. Imagine this in the binder. On the very front, you're going to have a list of all the accounts and what is the balance. So simply it's going to be this. We're going to have different accounts: cash, accounts payable, capital, accounts receivables, everything. Inside the account, we're going to have this journal, which is going to tell us what's happened. On this day, we didn't have anything. After that, we get this, then we can spend that much. Then we have this, then we can spend that much, we spend this, and right now we have that much cash. When we're putting all the cash, all the payables, all the capital accounts on one place, that will be our ledger. And in front of the ledger, we're going to have a list. Say, cash, that much. Accounts payable, that much. Capital, that much. If you ask, why my cash is less $100, we're going to open the ledger. We're going to go to the page that says cash. That will be cash account. We're going to see the journal, and we're going to see what's happened, what came in, what came out, and any balance going to come. Now, for simplicity, we're going to organize everything with the list. Every account is going to have a number. Now, those numbers are not random numbers. There's a logic in those numbers. What will be the logic? Coming from the basic accounting equation, assets equal to liability plus equity, means that if the resources are the one that we need to generate revenue, those will be listed with number 1. Now, from where the assets came from? They came either from borrowing, either from investing. Borrowing liability will be, all the accounts start with number 2 will be related to liability. All the accounts starting with number 3 will belong to equity. Then we're going to have accounts with number 4, which will be strictly related to revenue. And then we're going to have number 5, 6, 7, and 8. Those are reserved for the expenses. So how we have to remember it? Basic accounting equation: 1, asset; 2, liability; 3, equity. Revenue, increase the equity, number 4. Expenses, decrease the equity, number 5, 6, 7, 8. So at some point when we get in class, I'm going to give you one chart, which will be a chart of accounts, and I will ask you and force you, literally going to force you to have that chart of accounts always with you. The chart of accounts going to look something like this. Share my screen and you can see it. The chart of accounts going to look like this. With green, now basic accounting equation, asset equal to liability plus equity. Green will be the assets. Again, once you see account start with number 1, belongs to assets. Then assets came because we borrowed the money from the liability, so currently we own the money. The money that we owe for the outsiders is going to be number 2. All the accounts with number 2, liability. Money, the company that we owes to the owner of the company will be their equity. So we're going to label it with number 3. Number 3 is all the accounts reserved to the equity. Then revenue, increasing the equity, it's good for the owners. So that's why revenue, all the accounts start with 4. Then we're going to have expenses. First, we're going to start with the expenses related to the cost of goods sold for the merchandising company or any service company. That will be the cost related directly to our revenue, generating the revenue. Those will be number 5. And then we're going to have any other expenses which are related to the business itself. That's going to be 6, 7, even 8. So I'm going to give you this and I'm going to literally ask you to have this chart all the time with you, even on the tests. During the test, you have to have this chart in front of you. Okay, so let's continue now with the example here. The example here, chart of accounts, is going to be again assets number 1, liability number 2, equity number 3. Number 4, increasing the equity, revenue. Number 5, 6, 7, 8, expenses, decreasing equity. Now let's talk about something else, debit and credit. Now, for simplicity and for more logical order, we're gonna use double entries in accounting. So every transaction is gonna include at least 2 accounts. That means double entry. So what that means, whatever we get come from somewhere. So we're gonna chase what we get and from where that came from. You already know that nothing comes from nothing. So the question is, if you get something, from where that came from? If you get a payroll, if you have increase in your bank account, that's coming from somewhere. For what you did, you provide service to your employer. So basically, you're generating revenue, which revenue is taxable. As you already know, in Canada, whatever money you're generating, those are taxable. So we have to show on the Service Canada at some point how much we generate. How much we get, that's a different story. Here, for example, we're going to use company. Let's say we start in the company. There's nothing in the company. Company is blank. There's nothing. Bank account, 0. Liability, 0. Equity, 0. This company wants to start operation. What they need? Obviously, they need cash. From where they're going to get the cash? Either they have to borrow it, either somebody has to invest in the company. Let's see, let's try to borrow cash from the bank if we don't have operations, we haven't started our operation, and nobody invested in the company. What's going to happen? We're going to go to the bank. What's going to happen? Ask you, okay, how much assets you have? Well, if you borrow me 100,000, I'm going to have 100,000. So you don't have assets. No. What's your operation? Well, it hasn't started yet. Why? Because I don't have cash. But if you give me $100,000, I'm going to start my operation. And do you think the bank's going to borrow you money? I don't think so. So what do we have to do? First, we have to get somebody to invest. Usually, owner investing the money. The owner of the company who opened the company, who opened his business, he's the one who invested in the company. So when he invested, so what's going to happen? Let's say the owner invested $10,000. Now the company is going to have in the bank account, in the company bank account, $10,000, and the company is going to owe to the owners $10,000. Why? Because before the owner put the $10,000 in the company, those $10,000 was in the owner's personal account. Now he lent it to the company, but company is going to open an account for him and is going to say, okay, since you're the owner, you have a capital account. And your capital is 10,000, equal to the amount that you invested. $10,000, 10,000. Now, the company now has the cash. Now the company can start operate, can start some activities, right? The company is not going to buy flowers to the owner's wife because she agreed to put $10,000 in the bank account. That's not going to happen because when the company buy a flower for the owner's wife, that's not going to generate revenue for the company. But if the company purchase supplies, which supplies are related to the operation of the company, which we're expecting to sell later, that will be transaction for the company. So what's going to happen if the company buys supplies? Supply is going to go up, increase in the supplies, but if we pay cash, we have to decrease the cash. If we decide not to pay cash, that means we have to pay later, we're going to increase the liability. And we can keep going and keep going and keep going. We're going to see today. That's what we're going to do. How are we going to organize this? It's very simple. Let me stop here and going to move to one Excel spreadsheet. Let me open one Excel spreadsheet in my screen here. I'm going to explain all the ideas with the T accounts, with the debit and credit on the Excel spreadsheet. So you can visually see it. Okay, and that's my Excel spreadsheet. So first, remember, everything starts with the basic accounting equation, which basic accounting equation is assets are equal to, that's not plus, that should be equal to liability. Now it's the plus equity. Knowing that, where the equality sign is, I can draw a line like this, which literally is going to separate equation two parts. Now we have a left side of the equation and we have a right side of the equation. On the left side, we're going to have accounts, which the account's going to look like this, literally like this. T accounts exactly look like this. Let's put some bottom. And here we're going to put this. We're going to put some on the left side. This. And since this is belongs to the assets, as we can see, all the assets going to have beginning balance and all the assets going to have ending balance. This is for the assets. Now, what else we can do is the left side of the T account, we're going to call it debit. The right side, we're going to call it credit. So what the debit and credit means, we're going to see just in a second. So each account, asset account, again, that belongs to the assets, going to have beginning balance ending balance. Whatever comes in the account, it's going to increase the balance in the account. Whatever, if we have something coming in the account, that's going to increase the balance in the account. And if there's something going out, that will decrease the balance in the account. So, how are we going to find out how much we have at the end? Very simple. First, we need to know the beginning balance. Then we're going to add everything that came in, or all the debits. And we know that beginning balance plus the debit always going to be equal to whatever went out, all the credits, plus ending balance. This is the basic formula that we're going to know. How can I interpret this formula? Very simple. Now listen to me carefully. I want you to answer my question. Imagine you have in your pocket $30. You want to go and you want to do some shopping in Metrotown. You're going to ATM machine. You're withdrawing $200. You're going to Metrotown and you're spending $180. How many dollars left in your pocket when you went home? Do you want me to repeat it again? You had $30 in your pocket. You withdraw 200. You went to Metrotown, you spent 180. How many dollars you have in your pocket? Why there's a question mark? For those of you who saying 50 without question mark, what do we have to do? We have to use this equation. We have $30. We withdraw 200. That should be equal to whatever we spend 180 plus ending balance, which we don't know. We want to find out what's the ending balance. How are we going to find out the ending balance? Ending balance is going to be equal to 30 plus 200 minus 180. Make sense? Do you understand this? Let's make it simple. You have in your pocket $10. You withdraw 100. You spend 70. How many dollars you have in your pocket? Again, you have in your pocket $10. You withdraw 100. You spend 70. How many dollars you have in your pocket? 40. Yes. Make sense? Okay, that's one question. Now, the other question that can be, you have $20 in your pocket. You want to go to Metrotown, so you withdraw $100. You went to Metrotown and spent some money. You don't know how much you spent, but once you went home, you found in your pocket $20. How many dollars you spend in Metrotown? Listen again. You have $10. You withdraw 100. You went home, you found $20 in your pocket. How many dollars you spend in Metrotown? $90 will be the rate. So how are we going to get this $90? We have $10 plus you withdraw 100. Now, then we have credit, which we don't know, plus ending balance, which is 20. How are we going to find the credit? Well, credit is going to be equal to 10 plus 100 minus 20. Make sense? Is this difficult for you? Is this difficult for any of you? Because honestly, this is accounting, people. This is how difficult accounting is. This is how uh, difficult calculations we have in accounting. Because at the end of the day, either we want to know how much we have, either we want to know how much we spend. So those are the questions, and this is the problem that we have to solve in accounting. So that's for the assets. Now let's see what's going to happen on the other side of the equation, which the other side of the equation is liability and equity. Since we have two types of things, we have liability and equity, so we're going to have two sets of accounts, one for the liability and one for the equity. What will be different? Now, first thing first, the format will be exactly the same. The T account format will be exactly the same. What's going to change? Either is going to be liability, either is going to be equity. Either one of those. The next thing, since it's on the other side of the equation, we're gonna flip everything on the opposite side. So that means beginning balance is not gonna be on the left side, it's gonna be on the right side now. Again, we're on the right side of the calculation. So that's where we're gonna change the beginning balance. On the right side of the calculation, we're gonna calculate the ending balance. The other thing that we're gonna change, on which side one increase and on which side the other increase. Since we're on the other side of the equation, the right side of the equation, on the right side, liability and equity, it's going to increase. And on the left side, it's going to decrease. So what will be the equation here? How are we going to find the balances? We're just going to do some small adjustments. That again will be debit. That's not going to change. On the one side, we have debit. The other side, we're going to have credit. So what will be the equation here? The equation will be beginning balance plus the credit. It's going to give us the debit plus ending balance. And then we have two scenarios. Either we're going to chase how much is the ending balance, either we're going to chase how much we reduce liability and equity. Those are the two types of questions. And that's your accounting people. Now, where the complication can come from? If you forget which account where the normal balance is. So in order to remember it or to understand it, everything on the left side of the equation, which is assets, the normal balance always gonna be debit. Everything which is on the right side of the equation, like a liability and equity, the normal balance will be always credit. Do you have to remember this? Not necessarily. then what do you have to remember? You have to remember the basic accounting equation. Once you have the basic accounting equation, what you can do is go on the top and draw a line. I'm going to go with a thick line now. Go with the equality sign is draw another line down. Let me see which one I'm going to draw here. I'm going to choose this one and I'm going to go on that side. This look to you like a T account? We have the T. So what do you have to remember? On the left side is debit, on the right side is credit. So what that means? Everything which falls on the left side, assets, the normal balance is debit. Everything which is on the right side of the equation, liability and equity, the normal balance is credit. What that means? Every time when we adding the credit to liability and equity, account balance gonna increase. Every time when we put debit on the liability and equity account balance gonna decrease. On the other side of the equation is the opposite for the assets. Every time when we add debit, it's gonna increase the balance, and every time when we add the credit, that's gonna decrease the balance. How difficult this is for you? Is it difficult or it's okay? Give me some feedback, please. It's okay? Okay, let's go now back to the slides. So again, the T account on the left side, it's going to be debit. On the right side, it's going to be credit. Now on the T account, we can usually see what's happening with the account. Now, once we know the T account, then we're going to go a little bit further and go to the accounting equation. Assets is equal to liability plus owner's equity. Again, if we draw the T account, debit will be on the left side, credit will be on the right side. And since asset is equal to liability and equity, that means debit always have to be equal to the credit. What else that means? That means that the assets normal balance will be always debit. So asset always going to increase on the debit side and always going to decrease on the credit side. Where on the other side of the equation, since now we are on the credit, liability and owner's equity, normal balance will be credit. And both, every time when we put something on the credit is going to increase the liability and equity. And if we put debit's going to decrease the liability and equity. What will be the example here? Simple example will be owner invested cash in the business. The simple thing that we have to think is, did the company get something? Yes, it did. What the company get? Cash. So what increase in the company? Cash. What is the cash? Asset. On which side the asset increasing? On the debit side. So what that means? Debit cash for $250,000. So now I found something that increasing on the left side. From where that cash came from? Well, the owner invested it. So who is the owner? Well, he's the investor. So what's happened now? Now the company owes the money to the investor. which is the owner. So basically what we have to do, we have to open owner's capital account. So keep track of how much money the company owes to the investor, or how much is the balance of his capital account. And since that capital account is on the equity side, which is on the other side of the equation, credit on the other side of the equation is going to increase the equity. So now we have to make sure that debit always is equal to credit. So we debited the cash with 250. Now we have to credit with 250 owner's capital. Debit equal to credit. Asset equal to liability, 0. Owner's equity, 250, win balance. The next thing that can happen is with the cash now that the owner invested in the company decided to purchase a land for $100,000, and the company can pay cash for that land. So what's happened? Before we purchase the land, the company has $250,000 cash, which is equal to exactly the total assets that the company has, 250,000. Now, once we purchase the asset, now the 100,000 cash become 100,000 land. So debit land with 100,000. Credit cash gonna go down on the credit side with $100,000. But how much total assets we have? We still have $250,000 total assets. Why? Because we have $150,000 cash and $100,000 land, which is equal to the owner's capital, which owner invested as a cash initially with $250,000. In terms of showing the transactions, the first transaction will be debit cash. Again, create owner's capital. Now the second transaction will be, again, like assets gonna stay 250, but we're gonna move cash into the land. So now we're gonna have cash plus land equal to the $250,000. One more time with the rules. Assets, normal balance, debit. So what that means is asset always going to increase on the debit side and going to decrease on the credit side. Liability, on the other side of the equation, normal balance, credit. So that means credit is going to increase the balance, debit is going to decrease the balance. Equity, on the other side of the equation. Credit is going to increase the balance, debit is going to decrease the balance. Now we're going to special account, which is owner withdrawals. If the owner withdraw the money, that means his capital is going to go down. So the owner's withdrawal account will be opposite to the investment. So every time we put debit, that's going to increase the withdrawals. And every time when we put credit, that's going to decrease the withdrawals. But increase the withdrawals, that's going to reduce his capital. And decrease in the withdrawal, that's going to increase his capital. Now let's see from where the net income or loss come from. That comes from revenue minus expenses. So if the owner's capital increase on the credit side, that means the revenue increase in the owner's capital, that means revenue always going to have a credit balance. Now expenses. Expenses is going to decrease the owner capital. So for that reason, expenses always going to have debit balance. When the expenses increase on the debit side, that's going to reduce the owner's capital. And when the revenue increasing on the credit side, that's going to increase the owner's capital. So the normal balances, again, remember it from the basic accounting equation. Assets, always gonna have debit balance. Why? Left side of the equation. Liability and equity, always gonna have credit balance. Why? On the other side of the equation. Expenses. Now this one should memorize it, literally. Expenses, always gonna have a debit balance. Normal balance is debit. If you see credit balance on the expense account, something is wrong. Revenue, always have a credit balance. It's good for the owners, credit balance. If you see debit balance on the revenue account, something is wrong. Expenses, bad for the owners, debit balance, reducing the owner's capital. Withdrawals, special account, always debit balance. Debit balance gonna reduce the owner's capital. So if the owner invests $100,000 in the company and owners decide to take $10,000 from the company, well, he withdrawing money from the company. What's going to happen with his capital account? It's going to go down. So now let's start seeing those transactions and recording those transactions. First, before we start recording the transactions, I want you to think from where we're going to see those transactions, where we have to see some document which actually prove that there's a transaction, which transaction actually involved the company. So what we're going to have? What's the possible documents here? We may have a bank deposit slip. So every time when we deposit money to the bank, we're going to use that deposit slip. Every time when we're purchasing either inventory, either expenses, we're going to have a document as an invoice, which is going to tell us who's selling to us, what they sell us, how many units, what's the unit price, what's the total amount, how much taxes we pay. Then once we purchase, we have that purchase invoices for something that we purchase. Well, next thing is we have to pay. How are we going to pay? We can pay with the bank check. So the bank check is going to tell you amount that you're paying, on which day you're paying, to whom you're paying. Then we're going to have a sales invoice. The sales invoice will be the document that we're going to issue to our customers to tell them what we're selling them, how much we're selling them, and what's the unit price. How much is the total? Is there any taxes? Those are the called source documents. Basically, that will be the original document which is going to tell us is there a transaction which involving the company or not. So on the purchase invoice, if we have the name of the company, that means that invoice is related to the company. On the sales invoice, if we have the name of the company, that means that document belongs to the company. That transaction is related to the company business. On the check, if we have the name of the company on the check, that means that check is related to the company. On the bank deposit slip, it's the same idea. How are we going to recording those transactions? We're going to record those transactions on the sheet. If you remember on the drawer, every box is account, and every account we have a sheet, which is called journal. Now we're going to start journalizing everything that happened in certain accounts related to that box. How are we going to do those recordings? On the chronological order. What means chronological order? By logical date. We're not going to put May 15, we purchased this. On May 2nd, we purchased that. On May 31st, we're doing this. No. We're going to start 1st to 31st based on the date the transaction happened. So what we're going to journalize in there? First, we're going to identify is this transaction related to the company? From where? From the source document. Then we're going to identify which account is involved, which account increase, which account decrease. Remember, we have to follow the rule, debit, credit. So if something goes in, something goes out, or something goes in, something else increase. We have to find out what exactly is. Next thing that we have to keep in mind is we have to keep the accounting equation always in balance. Means assets always have to be equal to liability plus equity. And the last thing that we have to do is to put the journal entry. And in the journal entry, we have to remember this. Debit is always equal to the credit. Why? Because asset is always equal to liability plus equity. Once we keep everything in balance, life will be super easy. So the journal entry, again, we're going to include date, title of the account, so for which box from the drawer going, and from which going out. So we have debit in one box, credit to another box. Everything is pressed in the dollar amount. And we may include a short explanation. So for example, the owner's invested capital, which is cash. The owner invested cash as part of his capital. Debit cash, company is going to get the cash. Credit, owner's capital. So cash going up on the debit side, capital is going up on the credit side. Both increasing. We're increasing both sides of the accounting equation. Asset, it will be equal to liability plus equity, and debit is equal to credit. Once we have those journal entries, we're going to put it in that binder which have all the different accounts. We're going to transfer it into the T accounts, which T accounts are going to sit somewhere. So we're going to have here, when we have the journal entry, we're going to have T account for cash, T account for the capital. And we're going to start adding those one, debit, credit on the cash, debit, credit on the capital, everything related to that T account. Why is done with this way? Because financial statements are produced based on the transactions and based on the recording which is coming from the accounting cycle. We're always going to have a starting point and always going to ask questions whether transaction represents events to the company which should be recorded in the company ledger or not. If the answer is yes, then we're going to recognize it and we're going to record it. If the transaction is recognized, then we're going to use the element of financial statements, which will be the accounts, and we're going to record the information in the way that's understandable for everybody. If the transaction is not related to the company, then we're doing nothing. For example, owner purchased diamond ring for his wife. Is this part of the business? No, it's not. Is this transaction related to the business? No, it's not. Do we have to record it? No, we don't have to. What the owner spends his money for in his personal life is his personal choice, personal preferences. But if the owner buy diamonds on bulk because he owns the what will be that jewelry business, well, that transaction it's part of the business because he's not buying the diamonds just because he wants to buy the diamonds or because of his wife. He buying the diamonds because with the intention to produce the rings, which is gonna put the diamonds on and gonna sell it. Now that becomes part of the business. Now we have to record it. So we're gonna have, again, 3 columns. One column will be the date. Then we're gonna have the name of the account. Then we're gonna have the number of the account. Again, anything starts with 1, it's gonna be asset. Everything starts with 3, equity. Everything starts with 1, asset. Everything starts with 1, asset. So first transaction with the 2 transactions that we have, investment in the capital and purchasing the land, we're gonna have debit cash, credit owner's equity or owner's capital for 250,000 each, debit and credit. And then purchasing the land, debit land, credit cash with the same amount, $100,000. Why? Because we paid the $100,000 for the land. Now we have land for $100,000, and our cash went down with exactly the same amount. So once we put those in accounts, what we're gonna have? We're gonna have account cash with existing balance 150. Why? Because in the beginning we didn't have anything. Our balance was 0. Then the owner invested 250,000. Then we spent 100,000 for the land. Our current balance is 150. Then we're gonna have second account, which is land. Beginning balance was 0 because there was nothing in the beginning. Then we purchased land for $100,000. So that's why currently we have $100,000 in the land. Capital. In the very beginning, the capital was 0. Then the owner invested $250,000. So capital increased with 250, which is the amount that's staying up to this day. That will be our ledger with all the accounts, with what's happened in the account, debit, credit, and what's the ending balance. The last thing that we have to do is to prepare this called trial balance, which the trial balance will be the list of all the accounts with the ending balances. So the trial balance, we're going to summarize the ledger by listing all the accounts with only their balances. On the trial balance, you're not going to see what's coming in, coming out. You're just going to see what's in it. What will be the order in the trial balance? Same thing like accounting equation. And the numbers in the accounts. We start with 1, then 2, then 3, then 4, then 5, 6, 7, 8. Number 1 is assets. Number 2, liabilities. Number 3, equity. Number 4, revenue. Number 5, 6, 7, 8, expenses. And that's where we are. Now the balance, trial balance is not the balance sheet, obviously. Trial balance is all the accounts in one place. Balance sheet is something different. Balance sheet is financial statement, which we're listing all the assets with the total of the assets and all the liability and equity with the total of liability and equity. So now once we list all the accounts, since we're following the simple rule, asset equal to always to liability and equity, and debit is always equal to the credit. Once we see the balance, trial balance, you have to have the equality at the end. Debits have to be equal to the credits. So now, what if we see, what if here we have a different numbers? One possible scenario for the numbers is, I'm going to go back to the Excel spreadsheet and I'm going to explain this in the Excel spreadsheet. Just a second, to do some formatting here. So if one possible reason for the mistake on the balance sheet is simple mistake called transposition error. What is the transposition error related? Let's imagine we have a debit total. Now we have the totals. Total debit. And we have total credits. Let's go here, total. And those amounts are different. So let's say in the totals on the debit, we have 457,896. That's total debit. And the credit should be the same, but the credit is different. Let's say credit is 475,896. Obviously, there is a mistake. How are we going to find a mistake? Well, very simple, and what to look for is very simple. Get the difference between one number and the other one. So get the debit minus the credit. Once you get the difference, you're gonna get the number. That number, break it on the simple numbers. So that number is equal to, let's see, this number is equals, go with the simple calculation, 1 plus 8 plus 0 plus 0 and plus 0. And that's equal to 9. Once you get the numbers equal to 9, that means transposition error. What means transposition error? There's a flipped number somewhere in the list of the accounts that you have. There's a flipped number. If you find that flipped number, you're going to get it back to the reality. Make sense? So let's work with another number. Let's go with a simple number. Let's go 789 and 798. Let's go with those numbers. So our on the calculation here, the difference is 9. Now that difference is easy, so you can easily guess what is, because that's going to be equal to only 9. And since it's 9, you're going to get it, that is equal to 9. That one is easy to understand. Let's go with a different number. Let's go 72 and 27. Now, in this case, what's going to happen is our mistake here is 45. So what we have? We have 4 plus 5, and that's equal to 9. If it's 9, transposition error right away. That will be one possible mistake that you may find in financial statements. Again, simply go to the differences, split it by each number, calculate each number when you break it to a simple number. If it's 9, transposition error. Right away. You don't even have to think about it. That concludes our slides. But that opens opportunity now we to go to examples, which we're gonna do. So let's start with something basic and something easy. Let's see how is your understanding of this debit credit plus minus. Which one is the normal debit balance? Which one is normal credit balance? But before we do that, let's see if you can identify which accounts belongs to the assets, which accounts belongs to the liability, which accounts belongs to the equity, which account belongs to the revenue, expenses, and withdrawals. Before we start this exercise, one simple rule. Every time when you see on the account expense, most likely that's expense account. Every time when you see on the account payable, most likely that's a liability account. So now, from where we're going to get those exercises? Those exercises, we have to go to the Blackboard. Let's go to Blackboard. I'm going to go to, from the main screen, I'm going to go here to the Blackboard. Just give me a second to find where exactly it is because I didn't see it. Log in. Go to Blackboard. I'm going to log myself there. And let's go to our course, which is your section number 3. And there, if you go to course content, let me see if I updated your section. Yes. So what you can see here is practice question chapter 2. Once you click on that one, you're going to see question 1, 2, 3, 4, 5. Let's go with question 1 first. So what I want you to do is click on question 1. Can you see it? Should be able to see it. You can easily go download. And that's going to download in your computer. Once you download it on your computer, please open it. And once you open it, you're going to see this. Can you guys see it? No? Not yet? Oh, you cannot see my screen. But did you open it on your screen? Have you opened it on your screen? I want you to have it on your screen too. So go to the Blackboard, go to the, what was that, course content. Go to practice question. Chapter 2, at the very end, there's a practice question chapter 2, and we're dealing with question 1 now. Okay, so once you have it, let's go and start dealing with this. You can see my screen, right? Okay, so yes, both are on the same document. Well, the answer sheet, you need the answer sheet, right? At the end, once we finish that, so you have to see the answers. Now, if you want to look at the answers before we start, look at the answer. If you want to challenge yourself, don't look at the answers, and let's do it in the beginning. What you're gonna see is every time when obviously this one is made to be given in the classroom. Once I start giving you this type of things, sheets in the classroom, there's a simple rule here. On the front page, another section. What do you mean another section? Where is that section? On the Blackboard? No, all the sections have the same answers. All the same. Everything is the same. Solution at the end of the chapter questions. Those are for the questions which are from the textbook. Chapter 2 solution at the end of the chapters. Those are the solutions for the questions that you can see on the textbook after chapter 2. The questions that I'm giving you are different. They have nothing to do with those questions. They might use some of those questions, but technically those are here for the class. So let's go with this question. So what we have to do, we have to identify each of those elements, which is listed here. Is it belong to what kind of account is first? Is it asset account? Is it liability account? Is it owner's equity account? Is it owner's withdrawal account? Is it revenue account? Or is it expense account? So again, basic rule is this. Every time when you see expense account, unless it says prepaid expense. Prepaid expense is not expense account, is an asset account. Why? Because we prepaid for something which we haven't used yet. Can we ask our money back? Yes, we can. Since we can ask our money back and they have to pay us back, that is asset for us. That's what I want you to remember. Second thing, every time when you see payable, that's a liability account. Now, having this in mind, let's start with the first one. Buildings. What do you think the building is? What kind of account? Asset, liability, equity? I need more participation here so I can understand that you get it. Asset, okay. Let's go with the building repair expense. Expense account, correct. Wages expense. Expense, correct. Wages payable. Liability, correct. Notes receivable. We have to get something from somebody. So we haven't provided the service here. We haven't sold anything. We just have something to get. Asset account. Yes, that's correct. Receivables is asset account. So you can put that one in your head. Every time when you see receivables, that's an asset. So we have to get it. It's an asset. Make sense? Not revenue. Now let's go with the notes payable. Clearly liability, yes, that's correct. Prepaid advertising expense. My purpose is going to put this expense here because that's going to come to your first test. You're going to have prepaid expense. What was it? It's an asset. Yes, that's correct. It's an asset. Every time when you see prepaid expense, it's an asset. Why? Because again, we prepaid for the advertising, which starting from June 1st. Today is May 19th. By the June 1st, I can change my mind. I can say, I want my money back. I'm canceling that advertising. For that reason, since we haven't started using it yet, that's an asset for us. Let's go with the next one. Advertising payable. Sorry, advertising expense first. Advertising expense. Clear expense, yes. How about advertising payable? Liability, okay. Unearned advertising. Now, this is money that we get, but we haven't provided the service. So the client can ask for those money back. What will be that for us? That will be opposite of the prepaid. That will be liability, correct. Why? Because now we have obligation to pay back. In the first place, we have obligation to get it back. Now we have obligation to pay them back. Advertising fee earned. Now we start earning something. That will be revenue, correct. When we time, now we're providing the fees, advertising fees, which we earn. We're providing the fee, that's a revenue for us. Interest earned. We earn interest. Revenue, clearly revenue. Why? Because Canada Revenue gonna ask us to pay taxes on it. Interest expense. Expense, correct. How about prepaid interest expense? Asset, correct. Prepaid, once I put prepaid, make it asset. Interest payable. Liability, okay. Earn subscription fee. Revenue, clearly, yes. Let's go with next one. Unearned subscription fee. Unearned. We get the money. We haven't provided the services yet. Liability. So do you see those two? Now I want you to pay attention to those two. Now unearned subscription fee, once we're recording it, going to increase in the revenue on the credit side if we earn them, if we provide the subscription fee. If we haven't provided the subscription fee, but we get the cash, we're going to increase on the credit side on liability. Make sense? So if it's unearned, it's a liability. If it's earned, become a revenue. Make sense? Now let's go with the next one. Prepaid subscription fee. That will be clearly asset. Supplies. Asset. How about supplies expense? Expense. Rent revenue. It's a revenue, right? Now careful. Unearned rent revenue. Liability clearly. Prepaid rent expense. Asset. Rent payable. Liability. Service fee earned. Revenue, correct. Adjust yourself, it's not asset, it's a revenue. Earn it. So that will be service fee earned. Once we earn it, that means we provide the services, we earn it, or revenue. Withdrawal. Owner's withdrawal. Withdrawal counts, yes, owner withdrawal. Owner's capital. Equity, owner's equity. Salary expense. Expense. Salary payable. Okay, liability. Furnitures. Asset. And equipment. Asset again. Okay, great. Excellent. Let's do another one. Let's pull question number 2. Let's go and get this question 2. Download it. And I'm going to share my screen. Question 2. Once I open it, let me open it first. Once I download it, let me open it. And I'm going to share my screen. Now with question 2, there's 2 columns. Question 1. Let's see with question 2. some reason I don't see it on my screen. Let me try again. Okay, got it. So question 2. So what's interesting with this question? First, I want you to tell me, is it asset, liability, equity, withdrawal, expense, revenue? And once you tell me that, I want you to tell me what's the normal balance. Is it debit? Is it credit? So first, what we're chasing is on which side of the equation is. Remember, asset is equal to liability plus equity. So if it's on the left side of the equation, normal balance is debit. If it's on the right side of the equation, normal balance is credit. That's for asset, liability, and equity. Now, the revenue increasing the equity, so normal balance will be credit. Expenses decreasing the equity, normal balance will be debit. And withdraw a special account, which normal balance is, we're going to see in a second. So let's start with the first one, equipment. What kind of account is it? It's an asset. Normal balance will be debit. Correct. Land, asset. Normal balance will be debit. Correct. Withdrawal. Withdrawal will be withdrawal account. No questions about it. Normal, no, it's not asset. It's not a liability. It's part of the equity, but will be withdrawal account. So the normal balance will be debit because it's a special account. Withdrawal, that's why I left it. Withdrawal, normal balance is debit. Remember it. Why? Because decreasing the owner's capital. Every time when the owners take money from the company, that will be debit on the withdrawal, so that will decrease his capital. So normal balance will be debit. Rent expense. Rent expense, people. What account is that? Expense, normal balance will be debit. Yes, correct. Interest revenue. Revenue. And yes, normal balance will be always credit. Remember this, expense, debit, revenue, credit. Prepaid rent expense. What kind of account is that? Careful here, that's tricky. Asset account, normal balance will be debit, correct. Accounts receivables. Asset account, yes. Normal balance will be debit, correct. Office supplies. Why credit? Asset account is always debit. So the accounts receivables will be, no, office supplies will be asset account and normal balance will be debit, correct. Not receivables. Asset debit, correct. Not payable. Liability, if it's liability, goes on the other side of the equation, remember? So what will be the normal balance? Credit, not debit, credit. Adjust your mindset. Liability, credit. Equity, credit. Asset, debit. Owner's capital. Now show me that you know it. Owner's capital. Equity, credit. Correct. Rent earned. We earning fee from rent. What will be that for us? Revenue, normal balance will be correct. Now careful here. Rent payable. Rent payable. Liability, yes. Liability. Normal balance will be credit. We on the other side of the equation. We on the right side of the equation. Liability and equity, credit. Always. Let's go with the interest expense. Expense account. Normal balance will be expense account. Debit, always. There shouldn't be any doubt for the expense. Debit, always. And the last one, interest payable. Liability, credit. Good. Good. You're mixing it a little bit, but it's okay. It's okay. It's the first time that you're seeing it, so it's okay you to be a little bit confused. But again, practice, and you're gonna be there. So now let's see question 3. Now as you can see, getting a little bit harder. With question 3, it's gonna get a little bit harder again. Let's download this question 3. Open it. And let me share my screen now with question 3. So now for this question, we have to think which element of the accounting equation is. And once we find out what is it, on which side increasing and which side decreasing. So rule is, if it's asset, on the debit side increasing, on the credit side decreasing. If it's liability and equity, on the credit side increasing, on the debit side decreasing. If it's revenue, on the credit side increase, on the debit side decrease. If it's expense and withdrawal, on the debit side it's going to increase, on the credit side decrease. Knowing that, let's go with the first one. I have notes payable and I want to increase that notes payable. What's the note payable? What kind of account note payable is first? Liability, correct? How can I increase liability? On the credit side. That's correct, Karen. Let's go with the next one. Accounts receivable. What kind of account accounts receivable is? Asset account. How can I decrease asset account? On which side, debit or credit? On the credit side, yes. If I put debit, I'm going to increase it. If I want to reduce it, I have to put it on the credit side. Owner's capital. What kind of account is that? Or equity account, yes. How can I increase the equity account? So, okay, think about it. I want to increase the capital. Capital is equity account. Normal balance is, what's the normal balance for the equity account? Credit. If I want to increase that account, on which side I'm going to increase it? On the credit, right? I want you to understand it correctly. Don't jump, don't jump right away, debit, credit. Just think about it and make it logical, okay? Let's try one more. In unearned fees. Next one is unearned fees. What's the unearned fee? Liability. Now, careful now. I want to decrease the liability. On the debit side, yes. If I put credit side, I'm going to increase it. So with the debit side, I'm going to decrease the liability. Prepaid insurance expense. What kind of account was that? Asset account. I want to decrease it now. Decrease. I don't want to increase it. I want to decrease it. Credit side. Yes. Credit side. If I put debit, I'm going to increase the asset. If I put credit, I'm going to decrease the asset. Correct. Now, next one, cash. Asset. Yes, I want to decrease the cash. Credit. Okay. Utility expense. Expense account. How can I increase expense account? Debit. Correct. Now let's go with the next one. Fee earned. I produce the fee, I provided the fee, I earn those fee. What is this for me? Revenue, correct. How can I increase the revenue? Credit. Absolutely. Credit and credit only. Store equipment. Asset. Okay. Now I want to increase that asset. Increase. Increase. Correct. Adjust yourself. Increase it. Right? Next one. Owner's withdrawal. Owner's withdrawal, correct. Now I want to increase the owner withdrawal. So more he takes, less capital he has. Debit. Yes, correct. Rent payable. What kind of account is that? Liability, correct. Now I want to decrease that liability. Decrease it. I want to decrease it. I want to reduce my liability. How can I reduce the liability? If I put credit, I'm going to increase the liability. Remember, liability on the credit side going up. I want to go down. Debit side, yes. Adjust yourself for the liability place. Next one, prepaid rent expense. What kind of account is that? Asset account. Now I want to decrease it. Careful now. Credit. Yes. Supplies. Asset. I want to increase my supplies. Debit. Supplies expenses. Expense account, okay. I want to increase that expense. No, 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 no. I want to add more expense. Debit, 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 the expense. Revenue is credit. If I want to increase expense, debit. If I want to increase the revenue, credit. Expense, debit. Now, careful with this one. Accounts payable. What kind of account is it? Liability account. Now, again, I want to decrease, reduce the accounts payable. So, Link, you're still going with the first one. So listen carefully now. Liability and equity increasing on the credit side. and always decreasing on the debit side. Why? Because they're on the other side of the equation, on the right side, for all the people who saying credit. So if I want to increase the accounts payable, I'm gonna add on the credit side. In this case, I want to decrease it. How can I decrease it now? Make sense? I'm waiting for one more person to tell me that makes sense. That's correct. Asset to revenue, asset and revenue in the so hold on a second now. Now let's not mix it. So now let's go first. Asset increase. Let's go back to slides. Let's go back to the slides and clear this one. So what I want you to do is go back to this slide here, slide 16. And here where you're gonna see everything on one side. So asset, since it's on the left side of the equation, debit balance is the normal balance. So if the debit balance is the normal balance, every time when we put on the debit, that's going to increase the assets. Every time when we put on credit, it's going to reduce the assets. That's for the assets. Now we're going on the other sides of the equation. The other side of the equation, we're going to find liability and equity. Now the liability, normal balance for the liability and equity is credit. So every time when we put on credit, we're going to increase the liability and we're going to increase the equity. Every time when we put on debit, we're going to decrease the liability and we're going to decrease the equity. Now let's see for the income. Income is simple. Revenue credit, expense debit. Revenue is credit because increasing the capital. Expense is debit because every time when we increase the expenses, capital go down. So revenue always credit, expenses always debit. Withdrawal, since reducing the owner capital, normal balance debit. Is this make sense? Is that clear the picture? Okay. That sounds strong, yes. Good. That's good. Uh, do you want to have a break and then go with the more questions? Yes, we need just questions. So how we can practice is go over those the examples that we did today and try to find more things. Get comfortable with the accounts, where that account belongs. Get comfortable what's the normal balance for that account. And once you get the normal balance, then you can easily understand on the normal balance always going to be increasing. On the opposite side, it's always going to decrease. Do you guys want a break or are we going with more questions? How about the rest? Do more? Okay, let's do more then. Okay, good, good. Excellent. Let's do more. So what more we can do? Let me see where we're going from here. Just a second to check question number 4. Oh yes, let's do one question from chapter 1. I'll show you in a second which one I want we to do. And here on the blackboard, let's go to chapter 1. Go back to chapter 1. Case for practice. And let's go to question number 3. Let me see question number 2. Let first number 2, and then we're going to do number 3. Let's go with question number 2 first. Download that question. And now we have enough information and we can do question number 2. You don't see? Let's go, let me share again. So what I want you to do is go to Blackboard again. So on Blackboard, once you go to the course content, can you guys see it now? Go to course content, chapter 1, case for practice on the very bottom of chapter 1, and choose question 1-2. And let's do this question. So I'm going to stop sharing this. I'm going to have it open on my screen. Or no, not yet. Let me open it. So this question, similar question, you're going to see on the test, the first test. So one thing I'm going to tell you about the tests. First, on the tests, you're never going to see something that we haven't talked in the class. Second, you're never going to see something that I haven't stressed in the class. So every time when I say, you may see this on the test, that means interpretation should be, you will see this on the test. I don't want to tell you what you're going to see in the test, but I want you to know what you're going to see on the test. So I'm not going to use the words, this is what is going to be on the test, because that's too obvious. I don't want to be too obvious. But every time when I say, this might come on the test, that means that's going to come on the test. Make sense? That will be our way to communicate. The first test will be on June 2nd. So next time we'll be in class, and on the following class, we're going to have the first test. In the meantime, I'm going to check when the first quiz is due, which quiz is on Blackboard. And you can go for it and do the quiz. But for the quiz, I'm going to send you a reminder. Don't worry about it. So let's go now with this question. Can you guys see the question on your screen? 26, which is next. Okay. So let's go with this question. First thing first. This company, this consulting company, opened this on the May 1st. And everything that happened up to May 31st. What we have to identify? First, we have to identify, is this asset? Is it liability? Is it equity? Is it part of the balance sheet first, which is asset, liability, and equity? If it's not part of that liability, equity, it doesn't belong to the balance sheet. But we can identify now, is it revenue? Is it expense? What exactly is? So let's go with first one. Net loss, that's loss. So that's part of the income statement. We're not worried about that. Rent expense. What account is that rent expense? Rent expense. Expense account. Okay, that's not part of the liability. Rent payable. That's a liability. Okay. So let's highlight the liability with rent. We have to pay. Accounts receivables. Asset account, let's highlight it with green. We're gonna get the money. The owner invested in May. What will be that? Equity. Okay? Equity, we highlighted with blue. Interest revenue. It's a revenue account, not part of the balance sheet. Okay. Capital at the beginning. That's part of the equity. Repair supplies. Supplies. Asset account, so that's green. Not payable. Liability clearly. Okay. Withdrawal. That's part of the owner's withdrawal. Yes. Let's put it here. Truck. Asset, clearly asset account. Good. Consulting fee earned. Revenue, correct. Capital, we have to see how much is the capital. That will be equity, part of the equity. And cash. Clearly asset. Okay. Excellent. So now we have so the question that you're gonna see, will be listing different accounts and gonna ask you, how much is the total assets? What's the amount of the total assets? So what you have to do is identify which accounts are related to the assets, pull those accounts, calculate the balance. Then you're gonna ask him, how much is the liability? Then you have to pull out the liabilities, calculate how much is the liability. How much is the expenses? So for the expense account, I'm telling you clearly, you're gonna have prepaid rent expense. So if you see prepaid rent expense, what account is this? Okay, make sure you remember this. So if I ask you how much is the expense, don't jump and put the expense account as part of the expenses because it says expense at the end. It's not expense, it's asset. You're gonna remember this. Okay, so now let's see if this company makes something. So what's the revenue? Revenue is $2. And did they have any other revenue? How much is the total revenue for this company? $20. How much is the expenses? $22. Where is that? Income, where is it the income? Is it income or is it loss? Loss minus 2. Yes, it's loss, $2 loss. So the next question that you're gonna see on the test, who's gonna ask you, how much is the owner's equity at the end of the period? So basically, we're chasing how much is the capital of this person at the end of the period. How are we gonna get it? Very simple. What we're gonna get first? We're gonna get the beginning balance. We're gonna add investments. We're gonna add net income if there's any net income, or we're gonna deduct net loss. So either we're gonna have income, either loss. There won't be both. And the last thing is we're gonna deduct withdrawal. And that's gonna give us the ending balance. Make sense? Does this make sense? So how much is my ending balance here? How are we gonna start? My beginning balance is, it says here, my beginning balance is 0. So we're gonna start with 0. Plus investment. We invested, he invested, we don't. He invested $30. Then we're gonna have net income or net loss. In this case, we have net loss minus 2. Did he withdraw money? Yes, he withdrew $5 minus 5, and it's going to give us the total balance, 23. That's what you have to do on your test. Do you think you can do that? But what you have to do, you have to get the beginning balance, you have to see how much he invested, then you have to calculate, is it income, is it loss? That will be minus net loss. And then deduct the withdrawals. So there's a portion of calculation here for the income, because the income, you have to come up with it. Make sense? All right, let's do another question here. I'm gonna stop sharing this. You remember last time we did a question which involving the investments and all the things. Let's do the same question, but now with debit and credit. So basically what I'm gonna do is on the Excel spreadsheet, from chapter 1, I'm gonna pull question, let me see, is it 1-3? Just give me a second to see this question 1-3. Yes, question 1-3. I'm gonna grab the question 1-3. I'm gonna copy it, literally copy it, and I'm gonna put it on the Excel spreadsheet. And I'm gonna share my Excel spreadsheet. The one that we're working. After the class, that Excel spreadsheet will be available for you. Okay. You guys can see now my Excel spreadsheet. Let's go here, questions. That will be question 1. Let's go with here with question 2, and then we're gonna go here with question 3. So for that question, again, I'm gonna post, let's make it a little bit bigger. We have a space here, and I'm gonna paste this thing. Not the way I want it, but if I do some adjustments here, just give me a second on the alignments. Here we go. That's better. Delete those one. So we have something. That's our question. So for that question, what we're gonna do, we're gonna just do the journal entries. Can you guys see the question? Okay, so we're doing only journal entries, debit and credit. Okay, so let's go in chronological orders. So this company providing support to customers and area e-commerce. Following activity happened in March 2016. First one, the owner invested $25,000 cash into the business. So, what we have to do? We have to record. What we're gonna record? What the company get? Debit. Tell me, what the company receive? Did the owner give something to company? What the owner give? Owner's equity, he's gonna get the owner's equity, but what the owner give to the company? What the company get? Cash. So debit, cash. So if I put debit cash, I'm gonna increase the cash. Make sense? Do you understand this logic? If I put cash, debit cash, I'm gonna increase the cash. How much I'm gonna put in the cash? 25,000, correct? $25,000 cash. What else I'm going to increase? Now I have on the accounting equation assets, I have my asset. Now I have to do something and keep the accounting equation. Liability and equity. Which one I'm going to increase now? Liability or equity? Equity. Which equity accounts I'm going to increase? Credit, owner's capital, right? What do we know about the owner's capital? Always increasing on the credit side. Make sense? So now, in this transaction, what happened? Cash increase or asset increase, and the capital increase, which is the equity, also increase with the same amount. Make sense? Okay. Let's go with the next one. B. Now, it's not the owner, it's the business. Let's change here. The business purchase office supplies on credit. Now, what the business get? Debit. What the business get? Asset. What's called? Office supplies, right? And how much was those office supplies? $600. Now the question is, we have to go credit. Now debit is equal to credit. We have to go credit. Now the question is, we have to ask ourselves, did the business pay for the office supplies? Yes or no? Where do you see the business pay? It's on credit. No. So does the business have to pay in the future? Yes. So what's this for the business today? It will be liability, right? Accounts payable. That's correct. So it's a liability. Which account we're going to use? We're going to use accounts payable. And for the same amount, correct? We have to keep debit equal to credit. Let's go letter C. What's happening in letter C? Now, company order furnitures on account. What the company get? Debit. No, 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 no. Watch what the company get. Asset. Furnitures. Yes, the company get the furnitures. Nothing prepaid here. Furnitures. For how much? For 7,000, correct? Now the question is, did the company pay for the furnitures? Yes or no? No. Does the company have to pay for the furnitures? Yes. What is this for the company right now? Liability. What kind of liability? What account are we gonna use? Credit? Same account like before, accounts payable. Same amount, right? 7,000. Excellent. Let's go with letter D now. Careful, letter D is tricky. Now, company completed application form for $10,000 government grant. Now the question is, did the company get anything? Not yet. What the company did, they just completed the application form. They completed the application form. That's all. Did they get anything? Not yet. The question now is there transaction here? No. Do we have to record anything? No. So what we have to do? No transaction. No transaction. When you see something like this, and if you think and believe that there's no transaction, write me down, especially on the test, on the paper. Write me down. No transaction. You can write no applicable. You can write no. Anything that you showing me that you understand that there's nothing that you have to do. If you leave it blank, that means I I will think that you don't know what to do with it. And I'm not going to give you the marks. But if you write me no transaction or not applicable or no anything, communicate with me. There's nothing here. You can write me a memo, 2 pages. It's up to you. But write me down that there's no transaction. And I'm going to give you the marks. If you leave it blank, then I don't understand. Do you understand that there is no transaction? Make sense? So let's go with letter E now. Now, not the owner, let's go with the business. Now, the business paid for the office supplies in B. What's happened in B? We purchased those office supplies, we didn't pay for them. Now, let's pay for them. What we did here, we increased the liability. Now, what we have to do now? Since we're paying the liability, we have to reduce the liability. Make sense? How can I reduce the liability? On debit side or credit side? On the debit side. So let's go debit, accounts payable. How much? 600. And now I have to pay it cash. What's going to happen with cash? Going up or going down? Down. How can I make the cash going down? Debit or credit? Credit. Well, since we have the debit, now the next logical choice is we have to use credit. I cannot have debit and debit. That doesn't make sense. So 600, the same amount, and we're done. Now the next thing, the owner withdraw cash from the company. A, B, C, D, E, F. F in this case. F. So what's happened? Which account are we going to debit now? Owners withdrawal. With 1,250. And from what the owner get? Cash. Let's reduce our cash with 1,250. How do you feel? Is it difficult? Okay, let's do another one then. For the other one, what I'm going to use is I'm going to go to, now watch me where I'm going. I'm going to go to, now, chapter 1. No, chapter 1 is done. Let's go to chapter 2. In chapter 2, on the practice questions, we have here question 4. Let's try question 4. Okay, download the question 4. So far we did question 1, 2, and 3. Let's do question 4 now. So the question 4, what I'm going to do, I'm going to copy the transactions or the events that happen in the company, and I'm going to flip it to the Excel spreadsheet that we're using, and I'm going to share it with you. And we're gonna go here in the question. Let's go with the new worksheet, and that will be our question 4. I'm gonna paste it here, and I'm gonna make it wider, the entire sheet. And can you guys see my screen? Okay, let's go now. A little bit more transactions here. 2 more compared to the previous one. When you see March, so what when you see March 05, that means X can be 0, 1, 2, 3, 4, 5, 6, 7, 8, 9. So for some of the questions, when the educator using the questions, if I put 2015, that means I have to change every time the year. But if I put this way, I don't have to change the year because it can be 2005, 2015, 2025, 2035, any of those. Make sense? X is more like any random number between 0 and 9. No, it's not relevant at all. Not relevant at all to the question. X is not relevant at all. Yes. So every time when you see, yes, X is the variable. And anytime when you see something like this, 2000 x3, that means X is equal to 0 or 1 or 2 or 3 or 4 all the way to 9. So you can replace X with any of those numbers. So I don't have to change every year to go and change the question. The same thing that I can put is 2020x. I can go with this way. So that means from I can use this question from 2020 up to 2029. Make sense? So in this case, X will be equal to 0 or 1 or 2 or 3 all the way to 9. It's just for simple academical purposes. It's easy to write questions that way. Just put it this way. So let's go with this one. The year is 2025 in this case, because it's going to be this year for us. It can be 2015, it can be 2005, it can be 2045. So this company, transaction take place in this company, Logo Innovations. So first transaction, A. The owner invested $15,000 cash into the business. What the business get? Debit. Cash. How much cash the business get? $15,000. Okay. Let's make it presentable. $15,000 the business get. Okay, the business get 15,000. What the owner get? Owner capital. He gets his capital. How much is that? Exactly the same amount, $15,000. Right? So in this case, asset is equal to equity, debit is equal to the credit with balance in all the way. Let's go with number B. Now the business purchase $2,000 furnitures on account. What the business get? Asset. What kind of asset? Furnitures. For how much? for $2,000. Now, did the business pay for those one, for the furnitures? No. Does the business have to pay for the furnitures? Yes. What is this for business today? Accounts payable. Liability, and we're going to create account payable with the same amount, $2,000. Excellent. Let's go with the next one. C. What's happened in C? We purchased more furnitures, but now we pay in cash. Debit. Furnitures for $500. Now, which account I'm going to create now? Cash. Why I'm going to create cash? Because the cash going down. Make sense? Now I'm going to reduce my cash. D. Let's see what's happened with D. We did the work for the customer and we collected the cash. What we said the revenue. Can the revenue be debit? No. Remember it. So what the business get? Cash. Okay, let's get the cash. Once the client, listen to this, once the client paid, and once you smell that cash, get it right away. Debit cash. 1,000. Why the business? Now the question is why the customer pay $1,000? Because the business generated revenue. For how much? For the same amount. Now let's see what's the difference between D and E. In E, we also did the work, but did the customer pay in this case? No. So do we have to receive the money from the customer? Yes. So we have to debit something. Which account we go? Accounts receivable. Correct. For how much? For $700 in this case. Credit will be same like before, right? Revenue. For the same amount. Keep it in balance. Keep it simple, keep it in balance. Now, in letter F, we're gonna pay for the furnitures that we purchase in letter B. All of it. So so before on letter B, we created accounts payable. So we increased the accounts payable. Now we paying it. So what's going to happen with the accounts payable? It's going to reduce, right? So debit account payable. Did we pay everything? How much we paid? 500. Do we still have to pay? Yes. So how did we pay? Cash. So what's going to happen with cash? It's going to go down. Credit, cash with $500. Now let's see the opposite. The client here, we're paying accounts payable. Now let's collect the money. We're collecting 300 regarding the E. What's happened in E? We provide the service, the client didn't pay us. Now the client pays. G, client pays. What we get? If the client pay, what we gonna get? Debit cash, yes. Get that cash right away. How much cash we gonna get? 300. Did the client pay everything? No, we still have to receive, right? But what we gonna reduce now? Accounts receivables. Accounts receivable with $300. Excellent. Let's do another one. H. We did the work for client on credit. So which journal entry are we repeating? Accounts receivables? Letter E, right? It's just a repetition of letter E. What we're gonna change? Only the amount. How much is the amount? $400. Debit accounts receivables, credit to revenue for $400. Great job, people. Question for you. It's a tricky question. Which question is gonna come on the test? Listen to me carefully. Here the owner invested the cash, correct? Can you see it? The question is, can the owner invest computer? Imagine the owner invest in the business computer for $1,000. What will be the journal entry? What the company get? Debit asset or debit computer for $1,000. Now credit, which account we gonna create now? Think about it. Did the business purchase the computer? Did the business pay for the computer? Did the business have to pay for the computer? No. How did the business get the computer? Who gave it to the business? The owner. So what's going to happen now? Which account are going to? Owner capital. Make sense? Do you understand this? Stay with the transaction, right? Please stay. So I know this not here, this not here, but I'm giving you the example that the owner doesn't need to invest only cash. He can invest computer. He can invest truck. He can invest machinery. But everything that he investing is gonna go to his capital account. Make sense? This is out of this question. It's a tricky one. I just want you to understand. So let's see if we have time. Do you want to do one more question? Or you think, okay, good. Good job, people. Let me see, is there anything question 5? Yes, there's a question 5. Let me copy this question 5 and I'm gonna come into the Excel spreadsheet just in a second. So I'm taking from chapter 2, the last question, question 5. It's not the one. Just give me a second. For some reason, I cannot see this question. I'm seeing question 4. I don't see question 5. Let me see if the question 5 is actually question 5. Yeah, for some reason, question 5 is a repetition of the question that we just did in the beginning. Question 1-3. So there's no actually question 5. Let me see if I have here some other question on my side. Question 5. Yeah, it's the same question. So we already did this question. Let me see if I can find something similar so we can do one more question with you. But I like the way that let's go with this one. This is a little bit longer, but this is the question that we did last time. But we did it on the chart with the assets, liability, and the equity. So let's copy those transactions and we're gonna try to do it faster here. I believe we should be able to do it. You guys can see my screen, right? Yes. Question 5 here. And this is the question that I just grab it. So again, this is the same question that we did last time, but last time we did this chart with uh, asset, liability, equity, and keeping the accounting equation in balance. This time we're going to do the same question, but with simply with debit and credit. Make sense? Okay, let's go now. 1. This company providing computer services entered those transactions. So those transactions during the May 2020. 2, as you can see here, now I can replace instead of 22, it can say X2, and that's become a universal question. So now let's go with number 1. The stockholder or the owner of the company invested 36,800 in the business in exchange of common stocks. So what will be that? Business get cash. For how much? 36,800. That's what the business get. What the owner get? He get owner's capital, right? Credit owner capital for the same amount, 36,800. Okay, we have our first transaction. Let's go with number 2. Now, the business purchase computer on account. What the business get? The business get computers. Yes, that is correct. I want to do something. Just give me a second here. So I'm going to do something later on, though. But I'll tell you later what I'm going to do. I don't want to. So the business get asset, which asset will be the not this one. Sorry, I'm on the wrong Excel spreadsheet here. The business get cash, correct? Equipment, yeah, debit equipment, or that equipment is 27,600. And did the business pay for the equipment? Accounts payable, that's correct. Credit accounts payable. Now you can see at some point how the transactions start to repeating itself, especially in the beginning of the business. Either you're going to pay cash, either you're going to pay later. So the next one. Now they pay cash for the rent of the storage space. So let's see this. We haven't seen this transaction before. Let's see now. Debit. What they're paying for. What they're using. They're using the storage space. So what will be that for them? Is this related to the business or rent expense? Correct. That will be rent expense. How much they paid? 3680. And how they paid? Cash. So credit. Let's reduce that cash for 3680. Number 4. What's happening number 4? Now, we provide the service for $17,480 on account. Obviously, we didn't get any cash, but we have to get later, correct? So we're gonna debit. So let's change this one. Can the revenue be debit? No. So if you say debit revenue, credit accounts receivables, that means you reducing the accounts receivables and you reducing the revenue. Is that actually true? No. So what we have to do? We have to do exactly the opposite. We have to increase accounts receivables and we have to increase the revenue. Now tell me how can I increase the accounts receivables and how to increase the revenue. Debit will be accounts receivables with 7480 and credit will be which account? Revenue. Is it clear for everybody? I don't want you to be afraid of making mistakes, but I want you to understand. Make sense? Make a mistakes. This is the place that you have to make a mistakes. But once you make the mistake, I want you to correct your mindset and apply it after that. Yes. So revenue always increase on the credit side. Why? Because the revenue is good for the owners. Now, we providing the services. Once we provide the services, we generating the revenue. So we increasing the wealth of the owners of the company. Now, in this case, the customer didn't pay us. So we didn't get the cash. The objective is when you provide the service to get the cash, but we didn't get the cash. The question is, do we have to get the cash in the future? Yes, we do. So what will be that for us then? We have to receive something in the future. So that will be increase the accounts receivables and increase the revenue with the same amount. Every time when we provide the service, we're going to increase the revenue. And since revenue increasing on the credit side, we're going to put a credit. So for the same amount, 17,480. Make sense? No, you don't crediting. So listen, if you say you're crediting the customer, means that you're reducing the customer account because they pay you cash. Did they pay you cash? By crediting customers, you're reducing their account. Did they pay you cash? No. So don't reduce their account because you're providing the revenue and the revenue is on the credit side. As you can see, the expenses are on debit side. You cannot have the revenue and expenses on the same side of the equation. Make sense? Remember, revenue increasing the income, expenses reducing the income. So that's for that reason, revenue always is on the credit, expenses is always on the debit. Why? Because it's related to the owner. Revenue will increase the owner's wealth. Expenses gonna reduce the owner's wealth. Let's go with number 5. Make sense? Is this make sense? Okay. Let's go with number 5. Do you want me to finish this or we want to stop here? Finish this. Okay, let's go with number 5 then. Debit. Now we perform services, but now we're collecting the cash. Let's see when we're collecting the cash. Debit. Cash. Credit. I have to use credit. Give me credit. Revenue. What's the difference between this entry and the previous entry? There's only one difference. What is that? We got paid cash. That's the only difference. Make sense? In the first place, we provide the services. The client has to pay us in the future. In the second place, we still providing the services, but client pay right away. Do we have to keep track of the? Do we have to keep track of the customer who haven't paid us? Yes. That's why we're gonna open an account for them, and we're gonna call it accounts receivable. Let's go with number 6. Now we pay for the energy, for the electricity that we use, for the energy that we use. Debit expense, okay. That will be energy expense. And we pay cash, did we? Credit cash. With 7360. Let's go with number 7. Number 7, we paid now for the computers that we purchased in number 2. In number 2, we get the equipment, we didn't pay. Now we paying. So we increase the accounts payable, now we have to reduce the accounts payable. Correct. Debit, accounts payable with 27,600, and let's get it from the cash. As you can see, the only thing that we want in business is cash, and the only thing that the other businesses want is cash. Make sense? Now, during the business, we try to not to pay, but they still want cash. And they try not to pay us, but we still want cash. Let's go with number 8. Now we use advertising expenses, but we haven't paid for it. What did we get? Advertising expense, right? No. We getting advertising. We not providing the advertising expense. We using the advertising expense. So that will be debit, advertising expense. But we're not paying for it. Create accounts payable, yes. And that will be for 1196, and the same amount, 1196 is here. And the last one, we receive $11,040 cash from the customer for the contract built in, where was that built here? So remember, we provide the services. They didn't pay us. Now they're paying us. That's correct. Debit. Let's get this cash right away. Debit cash. 11,040. And credit, we're gonna reduce accounts receivable with the same amount because the client pay us, not revenue. So watch this. If you already provide the revenue, make sense? Here you provide the revenue, 7,480. You didn't get the cash. When you're getting the cash, you're going with the revenue again, that means your revenue is gonna be, here you're having 17,480, right? And if you show this as a revenue, your revenue is gonna become 28,520. So you have to pay taxes on 28,520. Is that your actually revenue? No, it's not. So be careful with this, right? Make sure that when you're providing the revenue, if you haven't received the cash, keep track of the receivables, and when they pay you, reduce the receivables and get the cash. Otherwise, if you go with the revenue, you're gonna double your revenue and you're gonna have to pay so much taxes, you're gonna get sick of taxes. I mean, don't get me wrong, Canada Revenue gonna love you. Canada Revenue is gonna say, thank you very much, please make that mistake again. Why? Because they're gonna get more money from you. That's not what you want. Great job, guys. Great job. I'm so proud with you, honestly. You did great today. For the first time, doing the transactions, debit and credit, you didn't ask me for break. Great. Impressed. I'm officially impressed. Now I want to see the payback for all 11 of you who stayed all the class. I want to see a good payback from your first test. Which not going to be next time again. Next time we're going to be in class. We're going to practice again. And then we're going to do the test on the June 2nd. Thank you for today. Amazing job today. Again, I'm super proud with you. Yes. And thank you for staying. Thank you for being here.